Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
It's always nice to be talking to you again.
Hilliard, are Canadians saving like Scrooge, as the old Canadian Tire ad used to say?
Yes, they got Canadian Tire money, and they got real money, too. They seem to be building up. Now, when you do those aggregate gross numbers of people's bank accounts, which is the only way you get it, of course, you see a huge increase, $55 billion, billion with a B, which is 25-30% increase in checkable accounts. So in other words, money that's just sitting, earning no interest, building up in the accounts. And presumably that's because of travel restrictions and restaurant restrictions and all kinds of stuff. So now I suspect that money is building up mostly in the top 1% people, because they tend to spend a lot of money on travel and they're not able to travel right now. And also they spend a lot of money on restaurants and wine when they go to dinner and stuff. But it's a huge thing. I mean, it's a very large amount of money. So it probably never happened before. And then among the lower income people, of course, there's been a lot of money built up because of the government help that they received. Although, when the mortgage deferrals end, and they've just ended in the last month or so, they'll find that they have to resume payments, and then next April they'll have to pay tax on all that money they received from the government. So there's going to be a little bit more difficult for them. But even the lower income people have some money built up in their accounts right now.
Well, I mean, I can attest, you're not going out to the pub to cheer on your favorite sports team anymore. Either they're not playing or you're not supposed to go to the pub. Yeah.
I was checking, and the NHL is supposed to start up January 1st, but with this second wave of COVID, you wonder if it's going to happen or not. It's going to be really interesting to see. I don't know if they'll can they play to an empty stadium or an empty arena in the NHL? I don't know how that's going to work.
Or would they just form divisional bubbles?
Yeah. If you could become a fan, you could be in the bubble. So you can't go anywhere. You just have to go to the arena and then go home and stay in the basement for 2 weeks or something. I don't know.
Well, I mean, the NBA and NHL seem to have done a good job forming bubbles and keeping their players and personnel safe during their playoffs. So perhaps their divisions could have bubble cities and, do it that way. They're going to have a reduced schedule anyway, but playing the same 6 or 7 teams over and over, well, hey, we did it with the original 6. Why not do it again?
Yeah, I guess they could. I don't know. It's hard to imagine, though. It really is with the, stories that we're hearing now about hospital wards filling up. Edmonton has, one of the major hospitals in Edmonton has 2 wards that are already full, although their intensive care unit is still okay, but the 2 designated COVID-19 wards are pretty close to full now, and it's apparently much worse than it was in April when the first wave hit. So we're gonna see a lot of changes in the next 2 to 6 weeks, I guess.
Once the mortgage deferrals end, are we going to see a wave of defaults?
So what's likely to happen there is, I thought that's what was going to happen, but checking with some experts in Toronto, they expect that people have built up, going back to where we started with all the money in the bank accounts. They expect that the people will have enough money to make the monthly payment for a few months. So we probably are looking at February, March, April next year. April looms as a large month. So people have some money built up in their accounts because they haven't had to pay for 6-7 months. They haven't been able to go out to restaurants and bars. They haven't been able to travel. They have that money built up, and then now they have to start paying again. So even if they don't have the work that they used to have, maybe both of them are not working anymore, they've got a little buffer there. Is it 2 months? Is it 3 months? Is it 6 months? We don't know, but let's say it's 6 months or so. And then, but next April, they're also going to have to file their income tax. And what people probably didn't plan for was the fact that that government assistance was all taxable, but no income tax was deducted from the check. So the check that came was for the full amount, and then now they're going to have to pay possibly as much as 20 or 30% of that back to the government in the form of income tax. So I think probably we're good for a couple of months at least, maybe into March, February, March, and then we'll see the crunch hit probably at that point.
The Deutsche Bank has suggested people should be taxed for the privilege of working from home. Well, if you're going to tax people for working from home, you should be able to deduct all your expenses in, part of your hydro, your property taxes, and so on.
Yeah, and you can. I mean, you can go to I'm not a tax expert, so I'll preface that, consult your tax advisor, but it's my understanding that you can go and apply for some tax relief it's probably not worth doing it unless you're in a high income tax bracket. And then, of course, you can only deduct the portion of the house that is dedicated to the home office. So you're probably looking at, maybe some percentage, maybe 20 or 25% at the most. And then, of course, the problem with that is, so you take in Canada, we have the tax-free capital gains on the home price increases, assuming there will be further increases from today, which, as people know, I don't really think there will be, but people have some really big gains built up, and I think that putting that at risk by tainting it by making the home a taxable event, to me, it doesn't really it makes it probably not worth it, in my opinion, because you don't want to really lose that taxable advantage. You wouldn't lose all of it. You'd have to do some complicated calculation, and it seems overwhelmingly difficult to keep track of all that. So for the small advantage people would get, I don't think it's worth it.
What's going to happen to commercial real estate with so many businesses finding that having their folks work from home is working just fine and they don't have to maintain some big office tower downtown?
There's one company, it's a Canadian company called Brookfield that is really in the forefront of this. So they own a bunch of office towers in Calgary, Toronto. They bought Canary Wharf in London. I don't know if people are familiar with that, but it's a huge development near London, England. I went there when I was a couple of years ago when I was over there for a conference, and I stayed there a couple of nights. It's quite the place. It was originally built by Olympia New York, who went bankrupt in 1990. And then eventually Brookfield, the predecessor of Brookfield, took it over. They own 3 buildings in Wall Street, downtown New York City, Manhattan, that were damaged by the 9/11 attack in 2001. And then they own a bunch of other properties elsewhere in shopping centers in Hawaii, and then they just bought a big chunk of shopping centers in the U.S. So they're making a huge bet and doubling down on that bet in terms of office towers and shopping centers. And yet, it seems like both of those things are really in trouble. So that would be, if people were interested in that would be a really good way to find out what to think. So this is a company that's probably worth $100 billion, and they have quite a bit of debt. They probably have $50 or $60 billion of debt. So they've been very aggressive in acquiring properties at a discount. They're now buying property. They're now investing in JCPenney. So JCPenney, the department store in the U.S., is the anchor in a whole bunch of shopping malls that they own. So they're trying to help them survive by investing in them. And so it's but I, well, of course, I'm always more likely to be the skeptic rather than the optimist. But I just see people changing their preferences in the online. I find the online shopping very convenient, and so I don't miss going downtown in this working from home period over the last 7 months or so. And I suspect a lot of people, it might be as many as 50% of the people don't actually resume traveling to the downtown every day. What is it, an hour travel? Some people 2 hours travel each day. You can get a lot of work done in 1 to 2 hours of travel time. So I think that I would be careful in terms of assuming that it's going to go back to the way it was. The most vulnerable place probably would be Toronto, because Toronto has a double whammy of people working from home. The transportation is being much more difficult in Toronto than it is, say, in Edmonton and Calgary. And then also on top of that, there's another trend, which is the amount of workers in the financial services industry, because all the big banks are headquartered in Toronto, pretty much, almost all of them, and they don't need as many employees as they used to need with automation and different things. So the combination of people working from home, the employers not needing as many people, and what's likely to be a pretty big surplus of office space would make owning an office tower in one of the big cities downtown, I think, a pretty risky prospect.
I wonder if we're going to see towers turned into vertical parks.
Yeah, people have talked about turning them into condos, but of course, wherever you've got office tower surpluses, like there is in Calgary, for instance, there's also a surplus of condos. So, there's been a story around for a number of years, going back at least 6 years now, I guess, when I was researching the first edition of the book, that Toronto had the highest number of cranes, construction cranes for high-rise, mostly residential, but some office towers, especially back then, 6 years ago, higher than New York or San Francisco or Los Angeles or Chicago or any of the bigger cities in North America. And so I just checked on it recently, and they still have the highest. I mean, they've got 117 cranes, and it's not, none of the other cities in North America are anywhere close to that. But what really shocked me, so still 6 years later, and today, unlike 6 years ago, all of those cranes are probably related to residential. There wouldn't be, I don't think there wouldn't be any office towers under construction in Toronto now. But what was really shocking was Calgary has 34 cranes. So Calgary is the fifth biggest operator of cranes for high-rise construction in North America. And, Calgary's only got 1 million people. So it's amazing how the developers in Canada have, kind of powered through this pretty severe recession, and continue to build. Now, of course, a lot of those decisions, the crane doesn't go up until probably a year or even 2 years after the start of construction, because you have to dig the parking garage first, and then you got to get above ground, and then the crane eventually goes up. But, so those decisions probably were made 2 years ago, but, the downturn in Calgary started, it's 2014, so that's now 6 years ago that the downturn started. So people continue to build even in the face of some pretty difficult circumstances. And obviously, the number one factor in that most likely is financing. So for multifamily, especially rentals, CMHC came out with some incredibly generous financing options for developers that want to build rental properties, and I suspect that has a big impact on these developers going ahead.
We'll have more with Hilliard MacBeth right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, does CMHC still have to apply a stress test to mortgage applicants, considering that we're being told by central banks they're going to keep interest rates low for quite some time?
Yes, they still are required to do the stress test, but they seem to be finding ways to cope with that. And the mortgage growth has been still pretty good, but a lot of that is probably people shifting their borrowing around. In the major centers like Toronto, the house prices are still held there. At least single-family home prices have still held their value. Condo prices are coming down pretty quickly, but single-family homes. So there has been some growth in mortgage debt. But in the credit card areas where there's been some huge drops, so there's been double-digit declines in the total amount of credit outstanding in credit cards. That's obviously people if they've got that much money in their checking account that we talked about at the beginning, then they might as well pay off. The first thing they're going to do is pay off that 20% interest on the outstanding balance on their credit card. So yeah, people are still managing. I find it kind of surprising. I think the private mortgage business has been phenomenal, and those people don't have to meet the stress test like the bank regulated lenders. So I think that is probably a big factor in keeping the thing going. But it is a surprise.
Are the banks still willing to kick out mortgage money even though the economy is shaky?
Oh, for sure. The commercial loan business is shrinking, and it's probably never shrunk before for any length of time since the early 1980s, when interest rates went to 18% or 20%, and there actually was a shrinkage at that time. That was the last time there was ever any decline in the amount of debt outstanding for commercial lending. But it is shrinking now, and so the banks have to do something. Their biggest business has always been the mortgage business. Well, not always, but has been in the last 2 decades. And but they like commercial lending. That's got a little bit more sizzle for them. The mortgage business is very cutthroat and competitive, so they don't make the profit margins on the mortgages that they do on other loans, like credit cards, car loans, and commercial loans. But credit cards are declining, commercial loans are declining, so they have to try and pump out the mortgage as much as possible, and they can if people can qualify. And that's of course the problem now is people might not have the incomes because they might not both people in the couple might not be working, or they might have getting less hours, or they might have lost their job altogether if they worked in a restaurant, or if they worked for WestJet or Canada, or they work for a hotel. They probably have lost their job altogether, or are about to lose their job. And so then they can't qualify. I don't know how careful the lenders are being in terms of, you show them a pay slip from a couple of months ago. Do they ask, well, do you expect to have a paycheck in December? This is the important thing, not whether you had a paycheck in September, but in December. I don't know how careful they're being, but I think, and then the other thing, of course, with mortgage loans is they have to have the collateral value. So the house has to be worth, or the condo has to be worth, more than the size of the loan by law. So that is another issue. If appraisals start coming back at lower levels, which obviously they are already on condos, then the loan has to be smaller as well. So that there's a lot of moving parts here, and but the banks are trying as hard as they can to keep the money going out the door, because if they don't, their profits will plummet.
Where are people spending this extra cash? We talked about it before we went on air. Home renovations, new cars. What are they buying? Yeah,
I think home renovations are just huge. I mean, that's totally anecdotal, and I haven't seen the numbers lately. They should be coming out soon, and I'll tweet them out when I get them. People can follow me on Twitter at HMACBE. Or they can follow my weekend notes as well, where I can write it up as well. But for sure, Canada was at 8% of GDP in home residential investment, which is primarily rentals. There's new homes in there. There's cost of commissions of buying and selling homes. And then there's renovations, but renovations is by far the biggest component now. These are huge numbers, and one would have thought in a recession that would decline, but my sense is it's probably not declined. People are work from home. Like in our house, we're doing a renovation in our home in the basement to set up a room for Zoom calls, because it turns out you can't have 2 Zoom calls going on in the house at the same time without taking a little bit extra trouble to make sure they're separated. So, maybe 2-story homes, ours is a bungalow, maybe 2-story homes will come back into fashion because they're able to have 2 different offices in the home. But yeah, renovations are booming. Booming would be the word for it. And, I've talked to several people that are in that business. They say they just can't keep up with the demand.
What about used car sales? I know a lot of people are leery of taking transit right now because of the virus risk, but they don't mind driving in their own little personal bubble.
Yeah, I have, I don't have the exact, overall car sales are down in Canada, and in the world. I saw numbers this morning out of Europe. Car sales are down 7%. Before the COVID recession, it was that there was a drop in car sales, and it was attributed to people's confusion over whether they should buy a internal combustion engine car or whether they should wait for the electric cars. Because there still isn't a really good offering other than Tesla for electric cars out, although it is coming soon. Volkswagen especially is really ramping up. I think they're going to have 12 models next year, I believe. And but on top of that, of course, then there's the COVID. So the used cars are, of course, generally much cheaper. So there has been quite a bit of demand for used cars, but overall car sales have dropped by 5, 7, 10%. New car sales, I should say, in Canada and in the U.S. and in Europe. But used car sales are hot, and I don't know why that exactly is. I suspect it's because they're cheaper. But people with that cash sitting in their bank accounts, and they obviously don't want to take the bus or the transit, so they feel like they need a car, and maybe they do. It's but on the other side of the coin is like my wife and I are sitting here, and we're working from home, and I'm looking at the garage, and there's 2 cars in there. I'm thinking, we don't really need 2 cars anymore. For neither of us is going to travel to work. What do we need 2 cars for? We could probably get by with 1. So there's that. I don't think people have reached that point yet. We certainly haven't, but I'm starting to think about it.
We'll have more with Hilliard MacBeth right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard MacBeth. The winter solstice, of course, the 21st of December, always a milestone in Canada because we know it's going to be another grim 3 or 4 months to go. But it's going to be a bright day for Tesla. How come?
So Tesla have been waiting to be asked to enter into the most important stock market index in the world, the S&P 500. So there's 500 companies in the index, obviously, and Tesla had been left out, and people thought they might have gotten asked to join earlier this year, and they got passed over. But the announcement was finally made this week that they will be included on, and that for some reason they picked December 21st. I'm not quite sure that. I don't remember it being like this before. It's usually you hear about it and it happens within a couple of days. So I think one of the reasons they might have picked a date so far into the future was that institutional investors need time, because Tesla is such a large market cap. So Tesla is a $400 billion market cap, US dollar market cap. And that'll make it immediately right out of the gate as one of the heaviest weights in the S&P. The heavier weights are are companies. There's a couple of companies like Google and a couple others that are over the $1 trillion level.
Amazon.
But it comes down pretty quickly. So I haven't checked yet, but I think Tesla will probably be in the top 10 and maybe even the top 6 or 7. So in order to make room for that, because the ETFs and the index funds all have to match the S&P 500 index, they have to make room to add Tesla in there. That's quite a big change for them, because if you get down to the bottom of the 500s, they're at the 1 billion, 2 billion level. I don't know how low it gets. It gets down into that range, I think. So they would have to get rid of 400 companies if they were all, obviously they wouldn't do that. They'd pick some bigger companies, but let's say 10 billion, they'd have to get rid of 40 companies in order to add in the 400 billion. Obviously they can't do that. So it's quite a big rearrangement for a lot of companies, and especially given the performance of Tesla, it's been phenomenal. It's a 4 or 5-fold increase just this year alone. They can't afford to leave it out, obviously, whether they're committed to tracking the index or whether they're actively managed fund that would be terrified to leave out Tesla and then watch their performance fall behind the index if Tesla continues to perform. So in any case, it's a big factor, and that's true not just for Tesla, but it's true for a lot of the renewable energy stocks. Because I know you and I have talked over the last few years about renewable energy stocks, and they have been phenomenally performing this year. The index was up 80% for the renewable energy, which Tesla is the biggest of the group, and Canadian oil and gas a little bit while ago was down 40% year to date, and the overall index was up about 5 to 10%. It's a little bit better than that now. So you can't, if you're a money manager or an index fund manager or an ETF fund, you can't afford to leave out renewable energy. And now that Tesla's going to be added in December 21st, it is the biggest of all of the renewable energy stocks. You can't leave out Tesla. So one would think that that would mean that Tesla would do well from this day forward. But I remember seeing a study a number of years ago, and I haven't had time to find it. I haven't been able to find it. I haven't seen anybody mention it yet. That showed that when the companies get added into the S&P 500, they don't necessarily perform well, and sometimes they perform poorly. So it seems hard to believe, because all of these funds have to buy Tesla now, and a lot of them perhaps didn't own it before. I noticed all of the companies like Morgan Stanley and Goldman Sachs and all these investment firms are recommending it as a buy now, and they weren't recommending it before, but they have to now because it's in the S&P 500. So it's going to be a big change, and it's coming in about a month from now.
Hilliard, thank you so much for chatting with us.
Nice to be talking to you.
My guest has been Hilliard MacBeth, author of the second edition of the book When the Bubble Burst: Surviving the Canadian Real Estate Crash. He's also a portfolio manager and advisor in Edmonton. His website, MacBethMcLeodGroup.com. You can find him on Twitter at HMACB. If you have any questions for Hilliard or any of our other guests, you can send them to info@HowStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter at HowStreet. We're also on Facebook. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.